Hey folks, welcome to CFO Chat, your front row seat with the Chief Finance Officer. Anytime a corporate action happens, you get the full lowdown here. Now, when KCB Group released their earnings, I was on travel, but because of the demand that I've received and the fan base of Lawrence Kimathi, let's have this conversation. Lawrence Kimathi, karibu sana.
Thank you, Julian.
Maybe it's about time I handed over this show to you. Lawrence, congrats on the half-year numbers.
Asante.
Special dividend, quite a sweetener there. The last time we were having a conversation, because one of the things which stood out for me, even the special dividend aside, is that the interim is up about 33%. And the last conversation we had was a conversation about we have spent quite a bit in terms of TMB acquisition as well as BPR. It looks like now that is fully behind us. Maybe let's start from there.
Yeah, I mean, as we explained, Julians, when we were releasing our full year results, we paid a full year dividend, or rather a final dividend of 2 shillings, and of course the market was disappointed.
Yes.
But we explained we have a lot of uncertainty ahead of us. The 2 years of the minorities in TMB had come to an end. We didn't know which direction it was going to go, whether we were going to get the 15% ourselves, whether they will get somebody else to buy. So, and that in itself is a sizable chunk in terms of capital allocation. So a number of uncertainties were in the air. Now that we are a lot more clearer in terms of direction, closing NBK was also was uncertain.
Yes.
So now that we are a lot more clearer, that's why we decided, hey, it's a shareholders' money. Let's let us pay them.
And Lawrence, I was one of the big skeptics and around the NBK sale, and here you are consummated it, and of course now special dividend. Maybe walk us through the tail end of that transaction, because it was one which was pretty protracted.
Yeah, it took a while. It took a while. The regulatory approvals, did take some time. The ones that came from CBN had conditions. So we sort of structured, because we needed to close the deal. Yeah. The uncertainty it was causing to NBK itself. I mean, imagine as a staff of NBK, it's been announced that you're being sold. It's a year later, nothing much has happened.
Yes.
You either switching off or you're anxious. So we spoke to both regulators, explained to them the impact this is having to the business. They agreed that let's go ahead and do a proper legal close, but get a financial guarantee so that we are certain that the financial close is going to happen within this year. And that's a structure we adopted.
Wonderful. It looks to me, because when I look at the group numbers, NPL ratio, of course, from a ratio perspective, year-on-year is up marginally. Mm-hmm. But from a quarter-on-quarter perspective, it is ticking downwards, which I think is a good thing. But I notice KCB Bank Kenya, it looks like a bit of the assets from NBK must have been moved to that side. Maybe give us some perspective on that.
Yeah, so as part of closing the transaction, we had agreed with Access that we will hive out a certain amount of assets. Yeah. And predominantly to really help them with capital compliance. So that from day one, if you hive out a certain number of risk-weighted assets, when you compute the capital adequacy of NBK, they are compliant. So yes. That was a key driver. And the best way to do that was just to take your top, we worked with about top 20. Now, in that, there were a number of non-performing assets in the customers that we took over into Kenya, and that is what has contributed to the increase in both the stock and the NPL of KCB Kenya. Actually, if you look at KCB Kenya without the hiving, their stock went down by about 6 billion quarter on quarter.
I see.
Yeah.
And now, broadly, now speaking from a group level, in terms of your ratio. As I said, from a quarter perspective, looks like it's trending in a favorable direction. Where do you intend to take this, especially towards the close of the year?
Our forecast is, as I said in the result, and I put our credit director
on the spot.
Yeah, we've given a range of 14 to 16. We are aiming to be at the top end of that.
Somewhere around 16.
Yeah, around 16, thereabouts. Yeah. But we've got to see every quarter, we've got to start demonstrating a reduction. We've talked about it for 2 years. This is, the first time we've seen, the numbers coming down two straight quarters, full year, quarter one, and now quarter two. We're seeing the numbers coming down. You know, they've worked very hard, to be fair to them. The environment has not been very conducive
for recoveries.
Even for restructures, because if a customer is owed money in the pending bills, they don't have cash flows that you can then say, I will restructure your loan because the cash flows you're showing me can only be able to support this. It's zero cash flow. So this innovative solution to securitize part of the fuel levy has come to unlock a big chunk of that. So, you know, I think the stars are starting to get aligned. I wouldn't say they're aligned, but they're starting to get aligned, and I think we're in a good position.
I see.
Yeah.
Lawrence, one of the things which stood out for me is, and this is actually across the banking industry, is because of the yield environment we are playing in and the interest rates and how they've evolved, and how the FX market corrected, the NFI seems to have taken a particular hit in this season. From a KCB perspective now, the balance between funded and non-funded is heavily skewed towards funded. Yes. What do you see as a pathway forward, Lawrence?
Yeah, I mean, we've got to get a lot more innovative, to be honest. This particular quarter comparison, we took a massive hit on FX. We had some one-offs last year. When the shilling sort of corrected last year, you know, we had a very good position that helped us in the P&L. That's a one-off, which was not going to repeat. So that base has impacted the comparison for the second half, you know, H1 of 2025. But that said, there are many other lines within non-funded income. You know, we've got you know, service fees, you know, which basically talk to all the channels, all the, you know, products that we need to bring to the market and start pushing, you know, diversifying our revenue sources, so that we don't depend solely on things like FX, solely on things like secondary trading of our government security position, and solely on fees that we generate from lending. So that's one part that you know, we definitely have to up the game and get that fee coming in.
Lawrence, on that point, when I comb through the numbers coming from peers in the industry, it looks like many have decided the margins game has moved. It's no longer there. We're now playing a volumes game. What are they looking at? They're looking at the petroleum sector players. That is an area where KCB is ceding ground. How are you positioned in view of that?
No, I mean, this one is always a funny one, because when we went,
there was no one else.
There was nobody else. Everybody else thought, you know, these guys, I don't know, they are smoking to take this risk on their balance sheet by themselves. The truth of the matter is that these were our customers anyway. You know, I think people misunderstood this G2G. You're not dealing with government. The G2G part is government has negotiated with the other government. But in terms of the actual transactions, you're dealing with the oil marketers. 3 of them were appointed, and you know, they were customers. Fast forward, last year, of course, the Uganda piece went directly to Uganda, so that reduced the cake. And then some other banks now started saying, by the way, putting my hand up, I'm interested in this.
A piece of the pie.
Exactly. So competition, we are defending. The Kenya team, KCB Kenya team is working hard to defend, because also we've been doing it for a while. We've built relationships with correspondent banks out there, with the current oil marketers. It's getting more competitive because obviously another bank will come and try and undercut you on from a pricing point of view. So we've got to defend, because the customer says, but I'm getting a better pricing from you. Why should I stick with you? So we've got to also, you know, find a way to keep those customers. The cake itself also is starting to increase, more fuel consumption. You know, people have sort of have stabilized on the price of fuel. We're seeing the economic activities coming in. So, you know, as that cake starts growing as well, if you maintain your percentage market share, it translates to a bigger number.
One of the overarching conversations from a broader policy macro perspective is the new regime in terms of risk-based pricing. And of course, now the question emerges as we switch to the interbank. What are some of the expectations you have from a loan risk repricing perspective? You've seen the moves the central bank has been making, especially around the benchmark rate. And granted, the interbank increasingly mimics what we are seeing in the interbank rate.
So I think that will help banks from being bashed, because today, you included, always bash us, but the CBR rate has gone down. why are you not following suit to reduce your pricing? And we always say it's because of how the risk-based pricing that has been approved by the central bank is structured. I'm still holding the deposit that you gave me last year, and I priced it at 15%.
Yeah.
It's still in my book. So I can't just reduce my lending rate because CBR has gone down. Moving to this unified one will help transmit the pricing much faster. So CBR rate goes down, the interbank rate follows suit, then that means that we really don't have any reason to say we are holding a more expensive deposit and I can't transmit. So that will definitely help the customers. It will also help the regulator in utilizing the monetary policy tools, because you reduce the CBR rate to try and say, let's push the private sector credit into the market because inflation is managed. But if that doesn't follow, you're not really, your monetary policy is not, policy tools are not being utilized properly.
Speaking about deposit, Lawrence, we've seen a very aggressive attempt by banks to unwind those expensive deposits in the half year that we have, for understandable reasons, because you want to safeguard your net interest income. How did it play out for KCB?
So it was a mixed bag. Remember, the rates really started going down, in leaps and bounds towards the end of the year, around December, to be honest. December is when we started seeing this coming in. Then January, February, the momentum really peaked. Now, we had, for risk management purposes, we had taken some deposits, long-term deposits, around October, November, which was sitting in our book for quite a while. So you're taking 6 months deposits, 9 months deposits. So those have now totally unwound, but they were really they unwound in June. So we can say we are now our balance sheet is carrying the more recent pricing of deposits.
Okay, switching on subsidiaries, Tanzania, from my own analysis, looks like it needs a bit of capital on its side. What's the plan around that?
So Tanzania, we will raise capital for Tanzania. As a shareholder, we will fund that. We are looking, trying to balance between tier 2 and tier 1.
Okay.
At the moment, the tier 2 pricing is not looking very conducive. So we might end up just doing tier 1. It's going to happen very early next year, once we get the shareholders their dividends first, and then capitalize. And equally, Uganda as well.
Exactly, Uganda too as well.
Now Uganda managed to get some good pricing on tier 2 because they had started a bit earlier. We expect that to be in their balance sheet in this quarter.
I see. And how are things going on the DR Congo side? When we had our last conversation, of course, there was escalation of tensions in the eastern side. I do believe, I could be wrong, that has tapered off a bit. How are things going on? So
the peace agreement has been signed. We are seeing a lot of normalcy coming back in, but it was quite prolonged. So I would say almost the entire H1. Our branches in eastern Congo were closed, and that's the risk of being the largest bank in terms of network. It means that you're all over. You cover the geography of the country. So if there are issues in parts of the country, then you get impacted compared to other banks that sort of concentrate on the commercial hubs of Kinshasa and Lubumbashi only. So that impact is showing in the numbers. If you saw the year-on-year movement of TMB, even from the targets we set them, we set for them, they've had an impact. They are actually here tomorrow morning, the management of TMB, 9 in the morning. We're having a deep dive into their business because we believe there's opportunity for them to recover in the remaining part of the year.
That opportunity, do you see it more on the funded side, non-funded side? Because that's a very peculiar market again.
Yes. It's going to be both, and I'll explain why. So the funded part of TMB still has room to grow.
Absolutely.
When you look at the loan-to-deposit ratio, you look at their deposits, they still have room to grow on that part, and we've allowed them a higher risk appetite. The non-funded side we have massive opportunity on FX.
Okay.
The FX part is big.
Yeah.
Our group treasurer has been designed a good strategy with them. If I'm not wrong, they probably have just landed a treasurer in terms of employment, getting more salespeople into the branches. We see a good opportunity in there. There's the other side of distribution of government salaries that also had been impacted because of the branch closures in Eastern DRC. With those opening as well, we see that part coming back. So that's why I'm saying DRC, the opportunity will be to grow both of them.
As we dial down our conversation, Lawrence, it's we're in an environment where, of course, businesses have come under immense strain from an efficiency perspective, including the banking sector. As we look towards the close of the year, how do you intend to ensure then that you're in line within the targets that you have set for yourselves?
Yeah, so top line is really what I'm pushing for.
Yeah.
After the results announcement, I was asked, what my view of H1 was, and it was a comical one. I think they've posted it on LinkedIn, and I said I'll describe it using music.
I'm not surprised.
H1 for me was a slow jam.
I see.
So it's good, you enjoy it, but I want a funkier H2. Yeah, and top line is really where we've got opportunity. So if you look at our total revenue year on year, 4% growth.
Yeah.
We managed to get our costs at a very good year on year of 2.5%. So we've got a positive jaw. But I believe that we should be able to do a double-digit top-line growth. Yeah. So get
H2.
Yeah. Yes, exactly. Get products, innovative products coming into the market. Focus on the non-funded bit. We've done a lot. To your point earlier in terms of volume of loans. We've done a lot, especially in Kenya, to try and bring in the volumes to mitigate the pressure on the NIMs. That will come into the second half of the year. So a lot of that was May, June. So you don't see the full impact of it in the first half.
Yeah.
It will come in the second half. But the non-funded part as well, we really need to push to get that top line growing. I want to see the NFI ratio up into the mid-30s where it sits. At the moment, it's just
about 29%, I
think.
I see.
Yeah.
All right. One of the regular viewers of our conversation, Lawrence, asked me, we are seeing a lot of conversation about KCB and the new app. Just how many apps does KCB have? Please respond to that.
It's a good question. It's a good question. Eventually, it will be one.
Eventually,
it will be one. So the new mobile banking app is really an app that we decided what we had before was just scratching the surface. Yeah, this is a mobile platform. Really.
Yeah.
It combines lifestyle with your need for banking. So it will go beyond just let me move money from my KCB to my M-Pesa, or let me pay some till number here and there. It will encompass your lifestyle. That's the aim. The platform has been built by a company that has done this in many other parts of the world.
Yeah.
So we are quite comfortable that it will work here. And Julian, like I keep saying, unfortunately, in the era we're operating in, you judge us when you go to Instagram and it opens and you do your stuff. That's how you expect when you go to
the same experience.
The same experience. So if you press on the app and it starts buffering, you're wondering, this guy, and that time maybe you're just driving past Kencom. They're just here and look at this thing.
Yes.
Instagram is in San Francisco and it's working. Yeah. So that is why we really say let's invest, and it also it's a big cog into our overall digital agenda. So we'll be able to do eKYC on this.
Yeah.
You don't have to come to the branch to get a form to give us copies of your ID. So long as the photo on your ID is very close to how you look now, yeah, you take a photo and it very quickly goes to the registrar of persons, checks the photo there and links.
Yeah.
Yeah. So you know, that's where we're headed. It's a big, big cog into our digital banking agenda.
Lawrence, you have no idea how many questions I received on this issue of the app, but let me close it at that. Now, my final question is this, Lawrence. You and I have had recurrent conversations about NBK when it was acquired, through the journey, and now offloaded, of course. When you look back, what are some of the lessons and what is the strategy going forward now that it's off the books?
Okay, so a strategy for expansion, I'm assuming, not for NBK.
No, of course. No, not for NBK, of course.
Yeah. I mean, there are lessons on NBK. As we said before, when we got NBK, the plan was to integrate it to KCB Kenya and, you know, just get the synergies on cost. Because many places where NBK branches are, KCB is there. So, you know, we could have been able to get the cost synergies. So learnings of when you make an acquisition, you have the reason why. Only a fool doesn't change their mind, but remember, go back to the core. What was driving us to get to this acquisition? And then you're able to extract value out of that. And we've been able to do that in Rwanda. With BPR acquisition, merger of BPR into KCB Kenya, KCB Rwanda rather, and maintain the BPR name. And you know, it's done quite well. Same in DRC with TMB. We say the name is got a lot more heritage than KCB. Keep it. It has done. The reason we are buying them is because we believe they are good, which includes their name. So those are some of the learnings I'll say we will take forward. We've talked about Ethiopia as part of our expansion strategy.
Any update, by the way, there?
Well, we are looking. We're very keen. We're looking. We visited some banks. It's now open.
It is, Lawrence.
So the regulator is really looking forward to a fast entrant into the market.
And KCB is keen on being the fast entrant.
We get a good asset that is strategically aligned, that is culturally aligned. Then we are happy to be the first.
Would you be retail franchise focused or corporate in that market?
I think we'll keep the same model, universal banking. So both corporate and retail, but also heavy focus on digital. So because of the size of the country, we need to be able to reach customers who are far and wide, and the best way to do that is digitally.
All right. And any horizon you're looking at as my final question on that side of the region, Ethiopia?
Yeah, within the next 18 months.
Lawrence Kimathi, we have to close it at that point. We've covered a raft of issues, right from the metrics of the performance, the special dividend, the mobile app, which everyone is asking about, and finally, expansion and lessons from the NBK acquisition and divestiture. Keep it CFO Chat for all the updates as and when they unfold.